Casey is taking a deep dive to look past the numbers and share what these reports have to say about the future of commercial real estate and what practitioners should be considering as the economy begins to open back up. Please feel free to ask questions throughout, and we'll do our best to answer as many as we can at the end of the discussion. And if you're experiencing any technical difficulties, please use the chat feature to help with you. This recording and the slide deck will be available after the session. And now I'll pass it off to Eddie to begin.
Hey, good afternoon or good morning or whatever time it is where you are. My name is Eddie Blanton, 2020 president of the CCIM Institute. I'd like to welcome you to this webinar today. Wanted to say that the last of the latest corporate earnings statement recently came in. There's a wealth of information in them. But did you know that there's also a wealth of info that can directly impact the way professionals do business? Casey is here today to take us through these statements, to share his insights, and to teach us how to fish. That is where we should be looking in these sometimes overwhelming corporate earnings statements for those golden nuggets of data. And more importantly, how to interpret that data into meaningful insights for commercial real estate. Thanks for joining me today, Casey, and congrats on your recent honorary CCIM designation.
Thanks, Eddie. I'm truly humbled, as I shared with you and Greg Fine and Barbara Crane when you shared the news with me. You finally figured out a way how to make an Irishman speechless. So I'm truly honored in that. I just had a couple of quick thoughts at the beginning. One, Eddie, I want to really thank you, Greg Fine, all the CCIM leaders and directors through this period, because it hasn't been an easy time to go through all this stuff. And when you think about, do I ever get real value out of all of my dues that I pay? I would strongly argue that this is going to be one year we're all going to be very, very happy to pay our dues, because all the things that you guys have done to step up and cross-pollinate with other industry associations has been tremendous, making us an essential service with the governors, working on 1031 exchanges. You guys have not missed a beat at all. So even though we haven't seen you a lot, we know that the gone fishing sign on your door doesn't mean you've just been looking at the earnings. You guys have really been doing a lot. The other thought I'd like to share is a good friend and good fellow CCIM, Jim Baker, as you know, published a book at the end of last year titled Confessions of a Commercial Real Estate Broker. I keep it on my desk and I look at his daily item and inspiration, and I just thought I'd share with you. It's very appropriate for today. Do you know what May 28th is in Jim Baker's book today? Mm-hmm. So the quick answer is, what should I have done differently? Like if you just understood earnings reports, but we're going to make y'all fishermen today. So thank you, Eddie. Thank you for all that you and the CCIM leadership has done, and I'm very humbled for the honorary designation.
Thank you. And yes, you're welcome. And once again, congratulations. It is our honor to give you that. And we appreciate having you on board with us and being able to share the pen. So Casey, what made you even decide to start looking past the numbers on these reports for industry insights?
So great question. So I'll share with you if you want to advance to the kind of the next slide. Part of it I would say was inspired by what your home chapter, the North Carolina chapter, had as its kind of inspiration quote of the day back on May 14th. And it's this quote by Ziad, the president and CEO of Blackhawk Partners, a private equity group in New York. A great quote. It was, starts off, life is like a camera. Focus on what's important, capture the good times, and if things don't work out, take another shot. So I'll reinterpret that in the Red Shoe language, Red Shoe economist language. Focus on what's important means go beyond the headlines. What we're going to do today, dig into the earnings, see what someone is telling us. What's really important is sometimes you got to dig into the nuggets. Capture the good times. That's my first kind of theme during this whole thing, which is look up and forward. We all want to get out of the cave. We all want to get out of the dungeons. We don't want to go backwards. So, go forward and capture those good times, look up and forward. And if things don't work out, that's the what if thinking. Things aren't going to work out. Things are going to be challenging. But if we engage in what if this, what if that, we'll know the right right direction to take at a fork in the road. And the last one, just take another shot. Boy, does that not embody adaptive reuse and the leadership that the CCIM Institute has had around adaptive reuse. So that's my interpretation of the great quote. But, I've been doing this for a long time, Eddie, and I've always tried to find, when you look at forecasts, we're all kind of like Winston Churchill. We recognize that God didn't give us the ability to foretell the future because we just couldn't handle knowing how things are going to turn out and what day we're going to die or how much we're going to lose in the stock market and whether our 401k will ever make it to what we need. So kind of quit trying, but it doesn't mean that the good Lord doesn't give us the opportunity and clues along the way to know which direction to go to fork in the road. And it's the earnings that have always helped me over the past decades to really understand what companies are doing. Those earnings are what will tell us far in advance what we should do.
Great. I tell you, we are in an ever-changing industry, that's for sure. So speaking of the headlines, let's start off with the top headlines you gleaned from these latest reports. Don't give away the story behind each one of them just yet. Just hit me with the headlines, please.
Yeah, so we'll start off. The new normal is behavior analysis. The headline there is, we know most of the companies have quit giving forward guidance. It's just too uncertain to do it. So instead of, if they're not going to give us a roadmap, we're going to have to look at what they're doing. What's their behavior? So we're all going to become part behavioral psychologists. We'll talk about that. The next one, a pretty interesting time to throw some bait in the water. This is a question all of us as CCIMs are going to receive. We do a lot of transaction work. We manage assets. We advise clients. And they're really asking, should I bail? What should I do with this property? What should I do with that asset? And so we're going to talk about what's in these earnings that help know us. When's it time to put some bait on that hook and go fishing? COVID-19. This is somewhat trite, but it is changing everything. But let's go beyond the everything and let's look at specifically what. In the zooming to the suburbs, this is one of the big debates that we're going to have is, have we just temporarily left the cities and gone home to our suburbs? Or are we going to go back to the cities? And there's some interesting things that companies are telling us already about that debate. And then the last one, we've talked about retail evolution, but we need to look also at hotel evolution and accelerating, beyond just the logistics. I wrote a piece that published yesterday called the other L&T industry, the leisure and travel. So it's not just the logistics and transportation, but it's the other one. So we're going to dive into each of these with your help, Eddie.
All right. Well, we're here to help, that's for sure. And a couple of those topics are definitely dear to my heart. So, okay, now let's go through each of them. Tell us what it means for commercial real estate professionals and how to apply these insights in our day-to-day. Let's start with your first insight. The new normal is behavioral analysis.
Yeah, so this is a quick slide to show you some of the companies that we're going to talk about, but we're going to cover about 10 or 12 companies. But let's look at this first one. So as I mentioned in the beginning, is companies suspend their forward guidance? Be honest with you, I'm hoping they never give it back to us for two reasons. Number one, the robotic traders on Wall Street don't know what to do unless they're told the numbers. They only know how to do algorithms and numbers. So they don't know how to do behavioral analysis and understand what companies are doing versus the numbers they're putting forward. So we're going to really have to look at that. And I'm really delighted to see the lack of forward guidance because we really have to go back to old fashioned, put the shoes to the pavement and figure out what's going on and talk to people. There are only two companies that I noted of any significance that are still giving forward guidance. Those were Pepsi and Pfizer. So Pepsi's a unique story. They're not, a lot of their plants are automated. They make things like Fritos chips and soft drinks and whatnot. They're highly automated, so they don't have as much of a worker risk in terms of outbreak. And then Pfizer, a pharmaceutical company. But other than that, everybody else has quit. So here's my recommended formula to capture the behavior. So it's one part, just quit looking for forward guidance. You're not going to find it. It's too uncertain. Companies aren't going to give it. They're not going to post something filed with the SEC under penalty of perjury and going to jail that they have to walk backwards. Second is one part psychology. So this behavioral analysis is, go back to your early 101 psychology class that you had to take in college and start looking at behaviors. So as you look at these earnings and you look at what companies, are doing and they're telling us in their earnings, look at the behavior mechanisms, like they've suspended, CapEx, or it's look beyond just they've suspended, stock buybacks. Look at what they're doing. We had a great one from Dollar General this morning. We'll talk about on the retail side. And I know you don't like talk about retail at all, do you, Eddie?
No, not at all.
We're going to draw you in, man. We're going to hook you in and we're going to bring you all the way into the dock on that one. And the last one is one part testing. So I really emphasize this. Whenever I look at these earnings and I see a behavior mechanism and something that I really think, oh, that's an aha moment, I step back and I want to test it against economic or property level data. So, look at other metrics that might confirm if you think, for example, companies are going to, close more locations or they're moving to the suburbs. I'm looking for other affirming economic reports, and we'll talk about some of those.
Great. Well, I tell you what, this next one I've been doing a lot of, with the shelter in place, because being from the Carolinas, I love my oceans, my lakes, my ponds, and my rivers. So now tell us about a pretty interesting time to throw some bait in the water.
Yeah. So before we go in there, this is, I talked about that confirming, one part confirming. This is one of those points, the CRE transaction activity. So if we think things are going to lock up and that COVID's really bad, one of the things we should be looking for is that investors are pulling back. And so in the upper left corner of this slide, this is what Real Capitalytics, they do a great job on tracking this, not just in the United States, but around the world. And they showed us that back in April, the early part of April, that we didn't have a big contraction in CRE. So everybody was thinking, okay, maybe CRE is going to be okay. Fast forward a month and look what we're seeing. We're starting to see our metric and our decline look a lot more like the rest of the world. But when you see these confirming data points, ask why. The why that's driving this for us is not a lack of interest in the CRE. It's this thing called the Pension Real Estate Advisory Association. And PREA has this thing where they've got to mark to market every quarter their assets. And after the first quarter, they didn't have a lot of evidence to show that they really needed to mark these assets down. But now here in the second quarter, the end of the June, they're really going to have to mark these assets down. So hotel and retail might get severe marks. Then they got to reallocate their dollars. And when they do that reallocation, I think is when we see it come back in. So for in the US, the decline in transaction activity has more to do with our institutional investors are having to deal with in mark-to-market accounting in the end of the second quarter and less about a lack of demand. Because here's my hypothesis. If you think institutional investors are going to go deep into bonds yielding less than 1% or stocks that aren't paying dividends, I think you're crazy. We're going to sell them a bunch of real estate, aren't we, Eddie? Because that's where the yield's going to be. We're still going to produce a pretty strong yield, 4, 5, 6 cash on cash cap rate. So that's that piece I want there. So if we advance to the next slide, we can talk about what you were queuing up on the second point here. Is this an interesting time to put some bait in the water? So as I mentioned at the beginning, this is the question that we're probably most going to get asked. So you're a CCIM, you've been through all the training, you've seen this rodeo a few times. Should I get in? Should I exit? Should I run for the hills? Should I stay at my lake or my hunting cabin? What should I be doing here? So the key and why I look so much at corporate earnings is corporate earnings telegraph to you. There's close to a crystal ball. They telegraph a good 6 to 12 months ahead of where the economy and economic data is going to be. So if companies say we're going to close stores, you're going to see that show up about 6 to 12 months later. If companies say we're going to move to the suburbs and we're going to lease more office space, we'll see that in leasing and CoStar type data 6 to 12 months later. So if you want to be 6 to 12 months ahead of where your the market data is and of real value to your clients, then this is one example. I'll give you a great one with Weight Watchers. So what's Casey, what are you doing? Did you get fat at home and not doing your Zoom exercises? My wife's been doing Zumba and I've been doing Zoom webinars. I'm getting fatter, she's getting more fit. But Weight Watchers told us something incredibly fascinating in their earnings. And they said before COVID, they did 75% of their business is face-to-face consultations with clients in an office park or in a retail center. They said within 60 days, they had pivoted that model to 75% digital. And they saw a record increase in subscribership and the highest customer satisfaction ratings they've ever had by being digital or virtual versus in face-to-face. And the CEO of Weight Watchers said, it's really got us thinking about why do we need a lot of real estate? And that got me connecting the dots saying, what if Weight Watchers isn't the only one? What does that mean for a gym, an LA Fitness, or all these other kind of experiential users of real estate? So I found Weight Watchers is really one of those good bellwethers to tell me what might happen to experiential retail type users. The other one that I pointed out is, I look around, I try to look around what's going on in my world. The old days where Eddie, we go out and we drive the neighborhood and we drive the real estate and look at who's there and why is this happening? There's no substitute for that. So I kind of do the thing. I walk around my house and I look at what my wife and my daughters and my young son are doing. And I found my wife doing Zoom Zumba, and she's still writing a check. So the Zoom Zumba instructor has given up her month-to-month lease in the retail center. My wife is happy as a clam with Zoom Zumba. She doesn't have to change or get dressed up, and doesn't have to do a shower afterwards at some, foreign, facility. So she's ecstatic. She's writing her check. So there's another one about what could mean for experiential retail. And then at night, I find while I'm working on a webinar or a content piece, the rest of the family's doing family night. They're doing virtual gaming. So when you think about all this experiential, could we have, family night Top Golf instead of a real Top Golf facility? These are those little nuggets that are coming out of these earnings that that can tell us, if we're advising a customer, is now the time to dump your center that has a bunch of experiential retail, or is maybe now a time that to double down and think about adaptive reuse, buying it an opportunity. So this question we're gonna have to answer for our clients to be really valuable is, when should I get in? When should I get out? When do I hold them? When do I fold them? What do I do?
Sure.
What do you think?
I
Crazy?
tell you, it's definitely interesting times, and as you and many on this call have already heard, I talk about we're in an ever-changing environment. Today's different than yesterday, and tomorrow will be different than today as well. And speaking of changing, let's keep going on the COVID-19 is changing everything. That really covers a lot of ground.
Yeah, so it's kind of trite, everybody's saying, it's change, and, they have their theories. So let's look at a couple of things that we kind of already knew. We've already probably figured out that COVID-19 has accelerated e-commerce. So at your inauguration out in San Diego, we released the Retail Evolution paper, and we had some forecasts to 2025. And I've been asked, well, Casey, do you need to update that paper? And I said, not really. Just take whatever I said was going to happen by 2025 and move it forward 3 years, and we're still on track with the paper. We'll just cross out the 2025 and put 2021. But there's a few things that were really fascinating on the e-commerce that I want to share, because it doesn't mean the end of the physical retail store. So look at the comp store sales that Home Depot and Walmart and Target reported out in the last week or so. Not only did they have strong e-commerce sales, every one of their stores had 3 to 4% same store sale comp increases. And that tells me the physical store is not dead. It might be that I'm going to do more order online and pick up, or I still do go to the store. So if you've got shop tenants next to a Walmart, Home Depot, or Target, guess what? They still have draw power, and they're still growing in the biggest e-commerce experiment that we've ever had. Then this morning, we got an incredible report from Dollar General. So Dollar General, they don't do anything e-commerce, right? It's a store where it's just what I forgot or I suddenly need, and I don't want to get out of the car and get the kids out of the minivan and everything else and go into traffic to Walmart or a Publix or a grocery store. It's how can I do it real quick to my house? I physically go get it. And Dollar General just blew the cover off the ball. It's like your son hitting a baseball, Eddie. I mean, he just knocked the cover right off. And they reported a record same sales store comps increase ever in the history of retail. It was 21% increase in same store sale comps. When's the last time you've seen that in a retail report? It's never happened. So the retail store is not dead. The next one is Container Store. This is one, I get so excited sometimes at 2 or 3 o'clock in the morning when I'm reading these things and everybody's asleep. I don't know who to call. I'll have to start calling you more at 2 in the morning. Is that okay?
Call on, come on.
Yeah. So the Container Store revealed something. They said, look, they were really hard hit. Most of their stores are not end caps, are not freestanding. They're in line into a center. They're not real conducive to order online and pick up. So their CEO said, look, we closed 51 stores during this thing, and we're not going to open them all back up. And as we figure out which ones we open back up, or if we have to go through bankruptcy, which stores are we going to keep and where are we going to do new leases, they've already written a new site selection criteria, and it's called Click It and Pick Up. And so they said, look, if we don't have enough area in the front of the store where we can have people pull up in lines and pick stuff up and drive through or a side entry, then we just aren't going to we're not going to renew that lease. We're not going to lease that store. And I think every retailer is going to really look at this closely in terms of your click it and pick up strategy, because not all of them are going to be delivering their merchandise that you order online in a Mercedes van by Amazon. And so I thought that is a whole new criteria and language that we're going to put into our site selection studies that we do. So I'm hoping our instructors can help work with us and get click it and pick up into our site selection criteria. and then it's about, connecting this behavior and what it means in terms of, think of all our traditional metrics that we had in terms of occupancy cost ratios and how we price things based on density. We had a fire marshal that told us how many people could come into a restaurant. And now we're probably going to have a public health official tell us that we need to cut those numbers by 25 to 50%. What does that mean for that business? If they're going to have less revenue, they can't pay the same amount in rent. They can't pay the same amount in rent. What does that mean for all of these ratios that we've been learning over the last decades? I think they're all going to be changed quite dramatically. And my last example here is Chick-fil-A. So I love Chick-fil-A, and yes, it is largely because I love the minis, but they're not quite as good as Smith Family Diner in Greensboro, Eddie. But it's a good.
Correct.
You can't have Smiths everywhere, but so Chick-fil-A is it. But I love it because of their business savvy. So before COVID, Chick-fil-A was already 2 years into a program where they were redoing all of their physical stores, and they had realized that kind of McDonald's messed up with their self-service kiosks and it didn't work very well. And so instead they developed an app that would allow people to more quickly go through the store through drive-through, but they weren't set up for a lot more drive-through traffic. So they decided, let's tear down all the stores. Let's move the store from the center of the pad to the back of this pad. And if it was a site that was only, say, a half to 3/4 of an acre, they got rid of those. And they went to everything to now almost a 2-acre pad site. And what they did is they added more drive-through. So they've got 2, 3, 4 lanes. They put in 2 kitchens. So one kitchen is just for the online app ordering, not to get screwed up with everything else. And they were crushing it. Then comes COVID. And now they're just even more crushing it. And what Chick-fil-A is reporting out and telling me is those new stores that were open before this COVID outbreak, their sales are up anywhere from 10 to 20% because they can do drive-through. So what does that mean for traditional out parcels with a Taco Bell? You have some of the smallest sites that you see out there. You're the expert on this, Eddie, with restaurants. What does it mean for a Subway where you can't drive through? They have to buy the store next to them and put a circle drive through the building.
Yeah.
So I'd really be curious of your thoughts, Eddie, because you deal with so much of this. But I think everything is going to change, and it's more than just more online. It's how we execute and click it and pick up, and these things like Container Store. Your thoughts as the wizard on retail. Any insights you're picking up?
I tell you, with the click it and pick up, or click it and pick it, as we call it, I'm already speaking to some landlords out there about taking out some small shop space to allow for additional drives, through and around the building just for those purposes, so that the big boxes will have more capability, and those small shop tenants that will survive will also have that capability in the future as well. So that's new to me, but we're already having those discussions.
Yeah, I think, we're going to supplement adaptive reuse to more productive use. Exactly what you're talking about. How do I make the tenants that are going to survive, how do I make them more productive? And I think you're exactly right. What are the innovative ways we think about how to do click it and pick it or pick it up? So you're the restaurant guru. I respect it.
Yeah, well, I'm glad I'm not sitting on a lot of the former Taco Bells, that's for sure, with an 8-foot or 10-foot drive-through.
They're kind of eating it right now, right?
Yeah, absolutely. So just to kind of continue on, what do you mean by zooming to the suburbs?
Yeah, so if we go to this next slide, this is before we get this good one would just show up. I forget, where we're going here, but if just go back one slide.
Okay, yeah, we'll go back.
Back from the Zoom one more. There we go, right here. The fastest growing in retail brands. So like we just talked about, everything changing. So look at who I found this graphic. If you don't know Visual Capitalist as a site, I encourage everyone to make it part of your daily read. Open Jim Baker's Your Confessions of a Commercial Real Estate Broker. Look at what the theme is for the day. Then go to Visual Capitalist and look and see if there's an earnings report. But they do a great job of visualizing information. And this one showed who were the fastest growing retail brands. And so you can see that on the left, and some of the ones we knew, like the Target and the Amazon and the Walmart and Flipkart, which is part of Walmart. But Lululemon, how many of you think that Lululemon is going to be the leader in the retail brands? I don't think anything apparel is really going to make it. And then you look on the right, and you can really see the apparel, the Under Armour, the H&M, and even the Walgreens, the pharmacy and drug stores. What's going to happen to those? So this should get us kind of thinking about that. So if we go to the next slide, Here's where it really hits home on how quickly things are changing. So on the left, here's this graphic, again, visual capitalist with Zoom. So this little company named Zoom that a year ago, we were kind of wondering, well, how does that work with GoToMeeting? And do I really need to be seen? I really don't want my boss and my clients seeing me. I'm casual at home today. Zoom, in less than a year, has become a company that is worth more than our 7 largest airlines in the world. That is mind-boggling. And where is the Zoom work going to be done? How many workers will they really need? Will they occupy office space? Then look at the airlines and how much physical retail space they use at airports, and the ancillary uses like rental car companies, like, you know, maybe Hertz going away and Advantage going away, both in bankruptcy. These are really transformative things we need to be thinking about. And as CCIMs, there's lots of room for us to be thinking about how this changed. The other one is the fast food, really kind of the Chick-fil-A story, thinking of just about how fast food has to adapt. And that, you know, I think many Americans find that, you know, they do a Chick-fil-A or other, the drive-through is a pretty good way to do it. And maybe they don't want to unpack the kids and they go into the restaurant. So I think for casual dining, we're going to rethink how that works, how drive-through works. Do we need as much parking? Do we need as much in-store space? Do we need 2 kitchens instead of 1 kitchen? So those are some good changes. So we can go on to the next slide. But those two, I thought, might put this in perspective. So zooming to the suburbs. You're there, right, Eddie? We're all in the suburbs. Anybody not in the suburbs?
There's a few still here in the center city.
Even all my colleagues, when I connect with people in New York today, they're not in New York. They're all gone out there. So a few things that came out of the earnings that helped me realize this is more than just a theory. It is actually happening. So the first came when D.R. Horton in their earnings reported. So you think, what can I learn from a housing home builder about commercial real estate? You can learn a lot. So D.R. Horton said, and they shared, their single largest segment of buyer traffic right now is young professionals, millennial age, that are renting apartments in the inner city. And while they still have a job and credit and a little bit of cash, they're leaving and not telling their landlord, and they're buying a house in the suburbs, entry level, first move up type housing. They're already doing it. So when the public home builder says grandma and grandpa or baby boomers aren't out here buying it, it's all the people leaving the city. So suburban Atlanta, suburban Charlotte, suburban Orlando, that they're all leaving. And so that's telling us this is probably when you move your housing, that's more than an anecdotal, that is a real commitment to things reversing. Equifax then connected the dots on office. So Equifax in their thing, besides the fact I wanted to know how they were screwing with us in our credit reports and their scores, one of the things I didn't like was they were boasting about their earnings because of the amount of credit inquiries. Everybody that asks for a rent forbearance or a loan forbearance gets a credit report check, and that's a negative on your credit report. So they're making a fortune charging the banks and everybody and the landlords for those, but they reveal something else. Equifax headquartered here in Atlanta, they occupy a lot of square footage in Midtown Atlanta and around the city. And they said, we have a new line item we want you to be aware of. It's called redundancy cost. And he said, we know that our employees aren't coming back to work. They're not going to take public transportation. They don't want to come into the dense city. They want to work remote. They've proven to us they can do it. But they do need to get together once in a while. They need to have some team meetings. They might need to meet with a client. And so we're having to rent and look for new office space in the suburbs near where our teammates reside. So they did a big analysis looking at where they lived. They identified there were 3 suburban pockets where most of them did, and they put a bid out to the brokerage community to help find them suburban office space. And they're a credit entity. They're going to pay their lease through where it runs out, probably for a few years, just like in the financial crisis. And then when those leases come up, they probably don't renew, and maybe they do a bigger commitment to the suburbs. But redundancy cost revelation in Equifax told me there is some very serious demand coming for suburban office space, whether it's redundant or the primary. The other one that I'd point out, as CCIMs, we all have to think about, we probably did a lot of transaction activity last year, and that activity may have slowed down because of what I shared earlier. So what are the skills that I have as a CCIM that I can use maybe in a consulting or advisory way to generate some revenue? And I think property taxes is going to be one of them. We could be an advisor to our local communities. How are they going to plug the hole next year, everybody that owns commercial real estate is going to be going in for a property tax appeal because of COVID. They may not want to get an appraisal initially because there's not a lot of comps. So they may turn to a CCIM or a broker. Remember the broker opinions of value that we went through in the financial crisis and how valuable brokers were pre an appraisal and a foreclosure. So I think there's a lot that can be done in the skill set of CCIMs around understanding the repricing, the density ratios, all of that are very important. I had an interesting couple of inquiries from law firms in the past week that are taking the position that these new density orders by governments, municipalities that say you can only open up your restaurant with half the density, they're thinking about taking the position that that's an eminent domain. That's a taking without compensation. And they want to know who are the experts they can go to help them understand how to quantify the damages. And so I immediately gave them ccim.com and the website by geography to look at there. And many of you have heard me talk about adaptive reuse. I want to throw one other out there in this debate between city or zooming to the suburbs, and that's college towns. So think about big cities and then think about college towns. They operate very differently. They have different economic drivers. And the college towns, I think, could be some of the most impacted in this whole thing. I'm going to give you some numbers. So we have about 360 MSAs in the country. 136 of them are colleges that play NCAA football. What happens to them? Does the Pac-10 even open up? So Eddie, feel good. The SEC is going to play football. I don't see Nick Saban in Alabama or anything. They'll play it somewhere, somehow. Vacant stadiums, they're going to play. Now, Pac-10 and West Coast, I don't think they're going to play. I really don't. So think about these college towns. Their Christmas season was graduation season, commencement exercise season. That 3 or 4 week period of time is when their Christmas is because they don't have a Christmas. All the kids are gone home for college or gone back home from college. So they lost 40% of their revenue. And now you look at, they didn't have summer camps. So all those summer programs are gone. There's another 20% of revenue. And then I have 2 college age daughters that don't want to go back to college. They've both told me, we don't want to go back in the fall. We're concerned. And they want to continue to try to do this online learning or remote learning, at least for another semester or 2 until they feel psychologically confident that they can go back. I listened to the dean of the University of Miami this morning talking about they had just built all these new dorm buildings and were ready to tear down the old ones. And they thought, wait a minute, maybe we keep those and we decrease the density of student housing to get students to come back to college. So a lot of interesting things going on there. We have 136 towns or MSAs that are college just for football. If you look overall, we have almost 200 college towns in this country, and they're going to need a lot of help. And it, just like we think about leaving the city to the suburbs, what is the impact with all the students leaving the college towns and coming home? And what does that mean for those communities? And so I think it really is going to boil down to what we've talked about. We did the paper on adaptive reuse. I think it's going to skyrocket. What do we do with these properties and these these other assets? How do we put them back to productive use? So those are a few of my crazy thoughts. Eddie, you think you agree, disagree? You going back to college? And we could go back now and we can get dormitories on the cheap, right? Maybe it's time for all the baby boomers to go to college.
It wouldn't be where we want to go, but you're right. The SEC and the ACC are going to figure out football, and there's a lot of students, including those my son's age, that are heading off to college that are looking to do the virtual to start with because they don't want to get there and then be sent home.
Yep. So this next slide ties in nicely, Eddie, and you can probably relate. There's a couple of North Carolina towns in here, and one South Carolina, Hilton Head and Asheville. So this was a piece I ran across. Zero Hedge, another great source that does really deep dive stuff. It's free. You can sign up for it. And they looked at what are the most impacted small and mid-sized metros with the most self-employed workers. And there's a couple common themes. One, they're either college or university, or 2, they're very substantial in leisure and tourism. And so you have a lot of small entrepreneurial businesses that do catering, or they have a business that really caters to the tourism or other industries. And so when we think about the impact on workforce, imagine Eddie, if we can't go to Asheville and cool off and play golf. Imagine South Carolina, we can't go to Hilton Head. Santa Fe, New Mexico, a great place. St. George, Utah, winter and skiing. We could see a real change in our landscape and how we travel and where we go, because look at where the self-employed workers are most concentrated. And again, these are smaller metros. I had a webinar earlier this week with your North Carolina and South Carolina chapters. I said the good news for the Carolinas is you're a very diversified economy. While you have great tourism in places like Asheville and Charleston and Hilton Head, You don't have a lot of markets where your whole economies pivot on this. So when you think about your state and your regional economies, think about this particular element. The self-employed workers are just absolutely devastated in this COVID environment. I think we have one more on the next slide. Might drive this one in. Oh, well, so kind of here, cue this up. We can talk a little bit about, the next thing here, number 5.
Well, just now that you've covered the zoom into the burbs, I agree totally. We're seeing that in my market here in Charlotte and also throughout the Carolinas, and I think we're going to see more of that in the future. So now this next one that you've spoken on before, and you actually wrote a CCIM Institute Commercial Real Estate Insights report on it. So let's close out with how retail and hotel evolution is accelerating along with logistics.
Yeah, so I'm going to spend a little less time on the retail. I think we all have it. That was a great collaboration with ACRE and CCIM that we did last fall, just to bring you in strong here in your world. But I think we also need to think about hotel evolution. And so I've been looking at a lot, Marriott and Hilton and Wyndham and others. And I published a piece with ACRE yesterday on what I call the other L&T industry, leisure and tourism and travel versus just logistics and transportation. And we've got to be thinking about what is the business model for a hotel where there's already ordinances in California and in Florida where they're talking about limiting the occupancy to max 50%, that every other room's got to be empty. They're talking about doing away with things like valet service, no touch, no interface check-in. So some of us were getting used to using an app to check in, but we still had to go to the counter and get a key. That's all being done away with. How about when you get to your room, it's sealed in a Vela wrap type of thing, and you got to cut the wrap to go in, and it's a way to assure you that no one's been into that room since they cleaned it. And then when you get in, you find that the bed's not made, that there's a linens package, and you got to make the bed, and you got to put the towels out because it's designed so that no one has touched those cleaned and sanitized items. Think about the rental car companies, what they're going to have to do in sanitization. Do they even survive? So Hertz filed bankruptcy, not because it was over leveraged on its real estate, because it was over leveraged on all the cars that it was buying and then trying to lease back out that they can't do. So a lot's going to change and evolve in hotels and the business model, and for CCIMs, what's the new, we do all of the financial analysis and the market study. What's the value in the repricing these hotels, where instead of 65 to 80% plus average daily occupancies, now it's max 50 or 60%. How does that model work? What's the price per room? What should the cap rate be? So a lot's going to change on the hotel side. I think we need to really beef up our skills and look at what the hotel companies like Marriott and Hilton are telling us already. The other one is on the warehouse. It's not going to escape unscathed. I call it logistics 2.0. So just like after the financial crisis, we had CMBS 2.0 to fix what was broken in securitization. We're going to find that we're going to have to fix that in logistics. And I'm telling you, if it's 3:00 in the morning and I'm already know I'm not going to sleep and I've read all of my earnings reports, I go abroad and I look at what the foreign companies are looking. I'm a freak of nature. So I found this one that we've got listed here, Elgi, ELGI. They're an Indian-based company. They're global, and they're one of the largest manufacturers of air compressing equipment. And they provide, and it's not just for auto repair shops, believe it or not, in your hospitals, pharmaceuticals, air compression is used in a lot of things in our economy. And they supply the majority of the compressors to Australia, North America, Asia, Europe, you name it. And LGI said, we're going to tell you how screwed up logistics and supply chain is because we learned it head on. And we found that how we communicated with other vendors around the world to make things come together, how we did shipping when shipping stopped, when we needed to move something, from Australia to North America and the ships weren't moving and the ports weren't open. And so they told us a lot about how far behind we are and what's going to have to happen in logistics. And I think this next slide may provide a visual for us on that, Eddie. Woke me up. So this is one that was put out again, Visual Capitalist. Can you tell I'm really into the visual of Visual Capitalist, how we visualize data. And so what they showed us here was they showed what percent of our warehouses are actually automated, that have robotic forklifts. They're not all of our warehouses don't look like FedEx and Amazon and UPS. And what they found is it's just a little over 50%. And then look at cloud logistics. We're not even at 40%. So we know where orders are going so that we can do blockchain and all that type stuff. If you look down there at the bottom, the 49% ratio circled, 49% of warehouse distribution center managers say they still use mostly manual processes. That is going to have to change. And what's going to accelerate it is this thing called supply stock. So we're going to get rid of the just-in-time inventory from the Japanese that they gave us in the 1980s when I was in business school. I just dated myself again, didn't I? It wasn't just my gray hair that gave me away, was it? So what we're going to find out is we got to deal with supply stock. So where's the additional PP&E, the additional ventilators, the additional toilet paper that we run out of? Where are we going to put it? We're not going to put it in our main e-commerce logistics warehouses. That's the throughput warehouses. We're going to have to put this somewhere else, and it's a new cost. And we're going to want to minimize that cost. So we're not going to build new $200 a square foot e-commerce warehouses to put this stuff. We're going to look for like secondary markets, like how to repurpose an old JCPenney store or an old mall. At Monmouth, the public REIT that I'm on the board with, we were one of the first ones to do it with FedEx on a failed mall in Mesquite, Texas. Amazon recently, one of our great CCIMs there in North Carolina that you may know, Karen Mankowski, sent me a great piece where they were interviewing Amazon, and Amazon revealed how they've acquired 23 malls in the last 2 years, a lot of them up in the Midwest and Ohio, and completely converted them to last mile in e-commerce fulfillment. We have a long ways to go in redoing logistics and automating. And so I think that even warehouse is going to have a ways to go. The box is going to become a lot more valuable. FedEx tells us at Monmouth that they're now using our fulfillment centers and our warehouses 24/7. And they basically said, don't talk to me about cap rate and rent per square foot. I'm looking at throughput per hour. And I'm running these things 24/7. So where I used to run them 5 days a week, I run them 7 days a week, and I'm running 3 shifts, or I'm running more and more robots. So the throughput's going to tell us that we've got to get more automated. And I think the supply stock is going to be a huge opportunity for our secondary markets and our retail side. Make sense?
Yeah, absolutely it does.
All right.
So let me ask you this.
Yeah.
We have a lot of overlooked sources of really relevant, timely data that all of us in commercial real estate should be leveraging. But right now, it's time for you to spill the secret KC sauce. So I'm going to put this in a 2-part question, okay? Where in these reports should we be looking for the data that would apply to our industry as number one? And number two, once we find it, how do we interpret it? Because maybe you probably should use 1 or 2 of your points you've made today as a case study example for us so that we can relate to it.
Yep. So if we advance to, I think, the next slide here, I'll give away my secret sauce. And y'all have heard me talk about transportation logistics, so we'll go beyond this one. So here we go. So y'all thought I was really brilliant, and this is why you had to give me the honorary designation. You gave up hope that I would pass the test, right?
That's right.
So here's my secret sauce, and it really isn't that hard. So step 1, you don't have to have a fresh MBA. You don't have to know how to read financial statements and earnings reports. I'm going to give you the Cliff Notes version, and you too can be brilliant. And now you know I'm just an average C+ student from Emory, and maybe now Coach Saban won't let me stay over there in Grayson at Alabama now that I've spilled the beans. So step 1 is select 1 or 2 free sources